A few months ago, Zacks published an article naming Union Pacific as one of the two railroad stocks investors could count on for dividends. I'll put a link to that article in the description below. Today, I thought it would be fun to and interesting just to revisit that idea and ask a simple question. Were they right? Back in 2025, the railroad industry wasn't exactly exciting. Freight volumes were soft, the economy was uncertain, and many investors were focused on faster growing sectors. Yet, Zacks argued that the Union Pacific stood out because of its dividend, its long history of returning cash to shareholders, and its aggressive share buyback program. At the time, Union Pacific was trading significantly below where it is today. Fast forward to now, and right now is June 16th of 2026. Union Pacific shares have appreciated meaningfully since that article was written. Investors who bought the stock have not only collected dividends along the way, but have also benefited from a strong increase in share price. So, at least so far, the basic thesis appears to have held up. But what I find even more interesting isn't the stock price. It's what Union Pacific's own executives are doing. Recently, several Union Pacific executives filed Form 4 disclosures with the Securities and Exchange Commission. A Form 4 is a document insiders must file when they acquire or dispose of company stock. Looking through those filings, I noticed something interesting. Multiple executives continue to acquire Union Pacific shares through the company's employee stock purchase program. Now, this isn't the same thing as the CEO going out and buying millions of dollars worth of stock on the open market, but these mostly appear to be routine purchases through the company's stock purchase program, but they are still purchases. And perhaps more importantly, many of these executives already own substantial amounts of Union Pacific stock. We're talking about tens of thousands of shares, and they're adding to that position. At current prices, they already have millions and millions of dollars worth of stock. Think about that for a moment. These people are making decisions at Union Pacific. They already have significant personal exposure to the company's success. Their fortunes are tied to the same stock owned by the shareholders. And despite already holding large positions, they continue to accumulate additional shares through the employee stock purchase program. That's not a guarantee the stock will go up, nothing ever is, but it does suggest management remains willing to keep a meaningful portion of their own personal wealth invested alongside the shareholders. Meanwhile, Union Pacific itself continues to return billions of dollars to investors through a combination of dividends and share repurchases. One of the reasons railroad stocks have historically attracted long term investors. They're not usually flashy, they're not typically the hottest stocks on the market, but they often generate substantial cash flow and return large portion of that cash flow to shareholders. So was Zacks right? At least so far? I'd say the answer is yes. The dividend is still being paid, buybacks continue, the stock has appreciated, and Union Pacific executives continue to accumulate shares through the company's employee stock purchase plan while maintaining substantial ownership positions. For a company that many investors viewed as boring just 6 months ago, that's not a bad outcome. If you have made it this far, I thank you for spending some time here at Railroad Economics today. My name is Mark Magana, and Monday through Friday, I upload videos about the business and economics of the railroad industry. That's something that remotely interests you. I hope you will watch more videos and subscribe and hit the like button and all that fun stuff.